This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap Podcast. I'm your host, Robert Kraft, and thank you all so much for the support and for tuning in. You can follow Planet MicroCap on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT, and you're listening to episode 151. If you have any questions or comments, please feel free to tweet at me or shoot me an email at rkraft@snnwire.com. And when you do get a chance, if you like what you hear, please rate and review Planet MicroCap on iTunes. It really helps provide feedback for me and spread the MicroCap message. Big announcement regarding our upcoming event, the SNN Network Canada virtual event, which is on January 6th and 7th, 2021. This morning, we shared the initial list of presenting companies. Paul and I are very excited about who will be joining us, and be sure to check all of this out on the event website at canada.snn.network. We've added more speakers and sponsors on the website as well, so stay tuned as we announce more presenting companies as well as the full agenda. You do not want to miss this event. I'm too excited about it. It's really awesome. Got an incredible lineup. So be sure to register now on canada.snn.network to join us for an incredible microcap event to kick off 2021. Again, go to canada.snn.network to check everything out. Now, for this week on the SNN Podcast Network, we have a solid lineup for you. After a brief hiatus, Avoiding the Crowd with Maj Soueidan is back and better than ever. This week's episode welcomes guest Rich Howe of Stock Spinoff Investing. As you probably guessed, Maj and Rich dissect everything you want to know about investing in spinoffs. So you can check out this episode on Apple, Spotify, YouTube, or Podbean at avoidingthecrowd.podbean.com. We also have a really fun episode in store for you on the Investors Roundtable. This week's topic is discussing the current state of affairs with cryptocurrency and blockchain. The lineup for this panel is stacked, and we have a whole lot to cover. I hope we can cover it in the hour and a half I usually allocate for this recording, but we have a lot to cover. So you can watch this episode on the SNN Network YouTube channel at www.youtube.com/SNNWire. Now, for this episode of the Planet MicroCap Podcast, I spoke with Liz Simmie. Liz is the co-founder and CIO of Honeytree Investment Management. Her firm, Honeytree Investment Management, builds quantamental public market portfolios for institutional and select private investors looking for concentrated, high-conviction strategies with full ESG integration. As the title states, and in this interview, Liz and her firm discuss why the current ESG definition may need a bit of redefining. And she makes the argument for why ESFG formula works for them. Liz is absolutely brilliant, and I think you'll really enjoy hearing her perspective. So thank you again for tuning in to episode 151 of the Planet MicroCap Podcast, and please enjoy my conversation with Liz Simmie. Back, everybody, to the Planet MicroCap Podcast. I'm your host, Robert Kraft, and joining me right now is an individual who we were originally, she was slated to potentially speak at our August show, but we couldn't figure it out with the schedule, but who cares? You know, we got the show here, so we decided to do an individual interview on Planet MicroCap, and I'm so excited to have her on here. It is Liz Simmie. She is the co-founder and CIO of Honeytree Investment Management. Liz, thank you for joining me today. How you doing?
Good. How are you?
Oh, you know, just another beautiful day in digital LA. You know, I wish I could be in the mountains right now, but or the surf. But hey, you know, it is what it is. You know, we'll make it work at some point. So how you doing?
It snowed here yesterday.
Where are you based?
Toronto.
Oh, that's right. Of course. Yeah.
So the kids were out rolling snowballs all day instead of school.
Oh, that is fun. That sounds like a good time. I mean, how's everything going in Toronto right now? I just talked to another colleague of mine up there, and she said it's lockdown.
Oh yeah. Our lockdown is kind of a soft lockdown. Like you're not supposed to go to cottages and stuff, but everybody does. You're not supposed to. So we've never had a full lockdown, and capital markets and investing has always been an essential business. And my husband's work in construction as well. So our lives other than school haven't changed very much up here. Other than our case rate's a lot higher now than it was in the spring. So we're taking it pretty seriously.
Yeah. Same here. LA, you probably seen the news. LA it's crazy. So it's like,
you guys, was it last night, yesterday you went into lockdown restriction? I saw something.
Remind me, today's Tuesday, right? Then if Tuesday, then yes. Yeah, it started yesterday on Monday. For those who are listening, we're recording this on December 1st. So yeah, yesterday, November 30th was a little safer at home, but you know what? We got to do what we got to do, and I mean, I've completely converted to a work from home situation. So we're all right. My wife is actually a nurse at St. John's. So she's, in the oncology unit, thankfully right now, but it's scary. You could get a case potentially that comes up. They do the test. You never know. They had it, but she's making it work. And kudos to everybody out there who's listening who is a frontline worker. We are fully indebted to you, and
absolutely.
Very so our task at hand today is I want to get to know Liz Simmie a bit more. Everything there is to know from an investing perspective. So let's start off with your background. I'd love to know where your passion for investing began.
That's a great question because it's, I think, the opposite of most folks. I did a econ stats and history degree in college, which you think would set you up for, the investment industry. But I avoided the investment industry. My perception of it was it wasn't changing the world positively. And, you needed to be an old guy in a suit and sit in an office and talk to people. And I don't know, that wasn't appealing. I wanted to do something more exciting and interesting and I guess purpose-driven. And I started my career in quantitative market research, actually. So I was one of those people who you got email surveys from or focus groups, and we did the touchpad sessions for consumer brands. So, cereals, bank products, you name it. And it's funny because it wouldn't seem like useful career experience at all for the investment industry when you say market research. But interestingly, it was kind of 4.5 years of foundational research training, quant and qual, and it kind of teed up when I got, and I'll explain to you how I got into the investment industry. When I got into the investment industry, it gave me a background in non-investment research, which I think is important context for folks when I talk about the investment strategy that we use. But I ended up in the investment industry by accident. My father founded a firm. So I ended up working for my father's firm until we founded Honeytree. And his third person, him and his co-founder, his third person was American, and he got divorced. And so he got kicked out of the country. And they needed somebody, I guess, not qualified, but they needed somebody to be that, junior analyst, junior operations, junior everything person. And I guess they thought of me and asked me to do it. And I thought, well, this was in 2011. Market research was, it was exciting. I loved the client aspect and the research aspect, but I kind of was looking for options. So I accidentally ended up the third person at a emerging manager. And for those folks, emerging managers, not emerging markets, just a tiny boutique asset manager, and got to be part of it from about 50 million in assets up to 1.5 billion when I left. So wow. That's that and the unique investment strategy that we ran is where all of my investment theory comes from. Before that I, invested, but not, I was always more of a manager selector. It's easier to, analyze a group of, not easier, but it's easier when you don't know what you're doing to analyze a set of managers' choices. But when you get into the long only equity business. So that's what I was trained in, and that's what I do now. The same research principles from anywhere can apply. We tend to do things a very certain way in the investment industry, in all asset classes, based on theory, but that doesn't mean an evidence-based approach, which is what we use and what we were, trained in market research, can't work. So that's kind of how I accidentally ended up in the investment industry. Spent the first 5 years kind of wondering what I was doing, what was interesting and unique, and then figured out a way to take it and take the training I got at my dad's firm and turn it into a purpose-driven organization that truly aligned with everything I believed, not only the quantamental portfolio construction, which we do, but using non-financial information in security selection. We use it to dig down further in governance. Is this leadership team, are they long-term focused, and are they sustainably growing everything? And this was part of what I was trained in, but at the same time, we weren't an ESG shop, and the ESG term is, even though I use it all the time, is problematic. But yeah, that's kind of the accidental story of the quick story of how everything kind of came together and ended up where we are now. There's so much opportunity in this industry. The gates are very closed. I am only here because my dad owned a firm. I make lots of country club jokes, but I'm not joking when I make country club jokes. There's a lot of regions in the world. Toronto's one of them where a lot of hiring happens at all levels and all parts of the industry through networks, whether it's private school or golf courses. And so we need to acknowledge that, and then we need to change that, right? And it's part of our role, somebody like me with that experience, to speak out as opposed to just pretend it's not a problem.
So with all that experience, and I mean, it's really quite impressive. And, from going to the market research, going to work with your father's firm, growing that from 50 million to 1.5 billion assets under management, starting your own firm. I mean, you went in your father's business, so you grew up with them, I would assume. What was, and you're probably managing your own money throughout this, even before joining his firm. So, what was it about investing, and when you were first getting into it, that really just got smart? It got you, and hooked you.
The process that my dad invented is what hooked me, but I thought everybody ran quantamental strategies that threw out a lot of traditional theory. So what really got me is when I realized how unique that strategy was, which was somewhere in the middle. And, when you talk to large allocators who are very sophisticated and very into process for concentrated active strategies, they help you understand why something's differentiated. So it took, I don't know, 4, 5, 6 years for me to truly understand what was driving out performance in the strategy, and why that wasn't, my dad being a genius or his partner being a genius. It was about a new process. It was about a new approach to portfolio construction that removed a lot of the human bias in the active management process. And so even though I'm really passionate about ESG all of the time, all day, every day, I'm actually more passionate about that and active management, long only specifically, any size equities, whether large cap or micro, is being done poorly. And it's not being done poorly because the market's fully efficient. If the market was fully efficient, I'm not saying that's not part of the problem, but the idea that active management underperforms, which has honestly been the narrative for the past 12 years, really drove me into kind of digging and research and understanding, so all these managers underperform and some of these managers outperform. It's not just a fluke that all these managers outperform. And I was lucky to be at one of the ones that was actually outperforming. So what drives outperformance in active? And it's discipline, staying away from FOMO, and high active share in the case of large cap, long only. And it's nothing else, and it's not rocket science, but folks think it is. And all my competitors are incentivized to make it sound more complicated than it is. And, there's the derivatives guys and stuff, which I call it funny stuff. Sorry, guys. It's great. I'm glad lots of people can do it. I cannot. I'm a long only investor. So my passion actually was kind of in that middle period where I realized that active management can outperform. Most doesn't. And it's really because of index hugging and bad decisions and ideas, right? And instead of process-driven and systematized research, it's ideas and essays and calls. And no offense to men, but a lot of that comes from the structure of the industry, built around Wall Street and, NBC and short-termism as opposed to long-termism, right? And I'd blame it on women equally if we were 50% of the industry, but we're not, so it's really not our fault. So that's kind of where my passion for investing hit. I would say, I did, lots of analyst research and stuff to that point, but for me, it was always a bit big picture and understanding the flaws in the industry, but also the opportunity in the industry. And then, ESG just added on to that.
Very cool. All right. So we're going to dive even deeper into some theory and your investment approach and how it's different and understanding better your definition of quantamental and how that works. But first, let's catch us up. What then led to your founding of Honeytree Investment Management?
Well, I met my partner, my co-founder, and she's an ESG person. So she was at MSCI, building at the Canadian market. And then she was actually the first ESG salesperson in the world. So the first person selling ESG data to pensions and managers. And that was like 15 years ago. So I knew nothing about ESG, and all this ESG stuff was popping up. And someone from my high school actually introduced us. And we hung out, and I was interested in ESG, not like just as a data set at that point for the old firm. And so we met, and we didn't, concoct a firm right there. But in that period, we were launching ETFs for my old firm. So I was very interested in the product that we had at the old firm and how it fit into SMAs in wirehouses. So that was a very interesting market for us in the US, in addition to active ETFs. And in Canada, just to be clear, ETFs are mutual fund structures. So you don't need to disclose your daily position. So we actually have tons of active strategies in ETFs up here, whereas it's much farther behind. I'm sure it's going to catch up in the US in the next 5 years, but folks don't launch a new mutual fund in Canada. They might launch a new mutual fund with an ETF series, but all the ETFs are replacing mutual funds up here. Anyways, so what was happening is all these big banks, Canadian banks, I got to do a disclosure here. They're like US banks. They score really high on ESG. They do a lot of activities. When you go to the asset management and the capital markets side of the bank, they don't care about any of that stuff. And so it's like they're all two parts. So the Canadian bank asset managers were launching all these ETFs, and they launched a gender equity ETF a couple months after I met Paula. And we were like, there's a problem with this. And it was kind of like the NASDAQ. So I don't know if you saw the thing today in the NASDAQ. NASDAQ's going to require companies to have.
I saw you post that.
Yeah, a woman or racial minority on board, or explain why they can't do that. And we've had an initiative like that in Canada. But this ETF, I'm not going to name which large Canadian bank it's from because I think they all did it. But it was a gender equity ETF. So it was the most gender equitable companies in Canada. And so it was the two big banks first, which is fine. They're not that bad. And then it had a tech company. And I was super excited. I love looking at top 10 holdings of strategies. And in the third company, my brother-in-law worked at, and it's a Canadian company, so nobody will, actually, you guys are all microcaps, so you probably would have heard of it, but I won't mention it. And I was so excited because it was the third most gender equitable company in Canada. And so I go to their board. There's only one woman on the board, no racial minorities. I go to the management team, and the head of HR is a woman. And I was like, this is BS. Trying not to swear. This is like totally ridiculous. You cannot call this a gender equity ETF for somebody looking to invest in gender equity if your third highest position is a company that absolutely does not care about gender equity. And so it was kind of a series of those products that made us realize we could take the quantamental portfolio construction, the evidence-based one that was not tied to traditional investment theory as much as many processes, and those processes tend to be tied to shareholder primacy, not stakeholder primacy. We could take that portfolio construction and bring in non-financial metrics equally alongside the financial metrics in both the quant and the fundamental part. And we just kind of clicked one day and we're like, let's figure out how to do this, because, it takes some figuring out how to launch an asset management firm,
Sure.
Especially up in Canada. You need a chief compliance officer, not like an appointed one. You need to qualify through the commission. So, and it takes a little bit more time and more money up here. But yeah, so we did that and incorporated 4 or 5 months later and launched after about 5 months of registration up here. And now we're 18 months into our track record, and we're going to do SEC registration shortly.
Very cool. Well, congratulations. I mean, it's for all intents and purposes a relatively new firm, and it sounds like you guys are making some headway and making some noise. So that's great.
Yeah, we are. This isn't a word of mouth industry. Doesn't matter if it's retail or the biggest sovereign wealth funds in the world. It's a concentrated group of buyers, and we get complimented, and we get asked why we chose Honeytree or why we didn't do this under the umbrella of the old firm. And it's branding, right? Branding and positioning are so much more important than anybody, especially in the investment industry, gives it credit for. And so your brand has to be memorable, and its purpose has to be differentiated, and whoever is communicating about it, whether it's us or word of mouth, needs to be able to share that information in. And so many traditional asset managers are branded like gray stone and dark and serious, and that's not the branding that's going to work for the sustainable investment group. And so we're very deliberate on that, and we've been very deliberate on our purpose and how that fits in, and it's not just for sales purposes. Let's be honest, it's for advocacy, right? We're not just here to make a pile of money. We're here to change the way securities are selected and change the way the industry looks. And those are part and parcel. How can you push diversity strategies and not do that with your own firm? And the investment firms are some of the worst in the world, even though we're selling this stuff, right? And nobody cares about the emissions of an investment firm, but neither do the investment firms, yet we focus so much on it, from an ESG perspective. So it's a very fascinating mess.
All right. So that was a perfect segue into our deep dive philosophy investing approach talk. So, you mentioned just now that your goal with Honeytree is really trying to change the way that you approach selecting securities and really just trying to make a change for the better from both an ESG perspective and using that quantamental strategy to do so. So let's start with the philosophy in general, and then also define for us what quantamental means to you and that approach.
So our basic philosophy is to hold the most responsibly growing companies in the world. And that's in a highly concentrated large cap, long only portfolio, about 20 companies. Quantamental is really an umbrella term. Traditionally, processes are fundamental, right? So traditional value, traditional portfolio construction methodologies are fundamental only. Even though they use quant inputs, they're considered fundamental deep dive. Quant processes tend to use quant processes. However, you use those, factors is one of the big ways to do them. But the reason it's the best way to describe what we do is because we use quant processes to cut down the universe to a small consideration set pretty quickly. Very high quality consideration set, and not in the factor sense, just in the pool of good companies to invest in. And then we do a further deep dive. So if we stopped at our quant process, it would be a systematic strategy. Because we do the deep dive, can't call us fundamental. We do traditional fundamental research, but because a chunk of the cut down, not most of our research time, because it's designed to be relatively efficient. So that's where the quant and fundamental term is. I didn't invent it. Some analyst we were meeting with a long time ago at my old firm said, "You guys are quantamental." And we're like,
sure.
Okay. It captures it because we never fit into the proper bucket, and Honeytree still doesn't as well. So when we talk to a consultant, some of the bigger consultants who are more tied to traditional theory, we don't fit in the quant bucket and we don't fit in the fundamental bucket. And we are quantamental. We are in between the two. And so it's the most useful term to describe our process. Our process is really just evidence-based. And it was designed not by me, by my father and his partner, to cut down, to remove the human bias in security, in active security selection. And that came from timing guesses, position sizing guesses, having too many things to follow, and ideas coming in, right? So if you built a strong structure of decision-making rules around whatever part of the process, and focused more on long-term, included lots of annual data in addition to quarterly, and we're really trying to assess the long-term consistent growth of companies, because over the long term, you want the companies growing most consistently, not in the short term. And that, that doesn't work for everybody's investment philosophy. Some folks are looking for short-term stuff. But in the long only equity, that's when you're long-term focused, that should be the goal.
Yeah. It sounds very O'Shaughnessy-esque. I'm already here. I can hear Jim in my head right now with that disciplined approach of like, here, remove the human bias, get that out of the way. Sorry.
Yeah. And the only difference between, I guess, us and them is factors are thrown out too.
Right.
And there's a lot of ways to get to where you need to go, but discipline is it, because, the biggest risk, there was a study, I don't know, a couple years ago, and it ran a model fake portfolio manager against actual PM sells and buys. And it turns out it's the buys folks aren't that bad at, versus like a randomized computer trial, but the sell timing, the timing of the sell is where so much of the error is added. So a fake computer model guessed and randomized sell times better than all the portfolio managers. So if you can make your decisions, your sell decisions especially, and all your research decisions based on systematized evidence instead of guesses and hopes and dreams, the closer you will be to, and all the steps you can remove from your process, doesn't matter if it's quant or fundamental or however you're doing it, the more process you can add and the less discretion. And again, you still need humans in art. This is an art and a science, no matter what anybody says. The quant guys still have an art in their design. It's not some machine, don't even get me started on machine learning. There's nothing wrong with machine learning, but the idea that there's not human bias in the approach is very, assumes a lot about the world. So you need all those parts, but you also need high active share. And that's where the concentration and the not looking like the index, FOMO, which most of your listeners will know what I'm saying, but I spell it out for lots of people. Fear of missing out is an underrated problem in this industry. And
guilty.
I can tell you, one, from my marketing and advertising background, that there's a lot more science in getting you to FOMO than you realize there is. That's literally like, it's an underrated aspect in because it's so word of mouth in the sales and in like me selling to RIAs and institutions and stuff. Security selection has also become a word of mouth. And so you hear Bitcoin or whatever, or FANG stocks. And I got to watch this firsthand as somebody who was coming in from the outside in the 2014 to 2018, when the FANG stocks were going up. If you didn't own those, you would be panicking because you didn't own them. And the only way to avoid panicking because you don't own them is having a process that's set up to make your decisions. Whereas even the most professional PMs, the most, the biggest endowment CIOs, we're all susceptible to FOMO. So how you integrate removing that from your security selection and your portfolio construction adds. And I'm not saying don't listen to research. I'm saying that there's a news premium. There's a popularity premium on a lot of securities at any size. And you can just see it in news frequency. You can see it in volume. You can see it in just basic coverage. I mean, one thing that happens in our strategy, because we're kind of agnostic to all that, is we hold a bunch of boring companies that don't have any coverage, because it's just not a requirement. And it doesn't mean that they're bad. It just means they're not cool.
You're a microcap investor at heart then. I mean, this is the, let's be real. I'll just give.
It is funny because I think, I think different parts of the industry separate from the traditional, let's say, large cap or the hedge funds are more likely to be innovative and inventive because they're not tied to as much. I call it Bay Street tradition up here, Wall Street tradition in the US. And so the closer an investor is to that circuit, the more biased they're likely to be, just from news and proximity and regularity of conversation to think that for the FOMO to impact their decision making.
And what Liz is trying to tell everybody right now is she's actually in a cottage somewhere in the middle of the woods, so she is not susceptible to any of that at all. I'm done. I'm teasing.
It's, you have to build a process that, yes. and what we do, just to go more in the details. So we start with the whole global index. I'll be that general. And we have 25 qualification criteria, and some's financial, some's non-financial. For example, we use Glassdoor ratings. But we cut out a lot of traditional evil stuff like guns and weapons of mass destruction and fraud and things like that. So it is, I say it's a quant process. There's a bunch of qual deep dive research in that as well. But we take the universe from thousands and we cut out like dictatorships and stuff to it. And this is over 5 billion, by the way. And we get down to 45 companies. And it depends on the year. We kind of range from 43 to 45, and we do this once a year. And so if it's not in that consideration set, doesn't matter what news is going on. We're not adding it. It has to qualify for that consideration set. So that's how we cut out the noise. And so we can look at all the noise relative to our consideration set, but frankly, other than those group, we ignore that. So that's how we use the quant to cut out the FOMO.
So just one time a year, that's when you do kind of you run your system, and you see what 45 companies come up, and then you decide from there which ones you're going to add. So what's your normal portfolio turnover percentage? Like
it's only been alive for 18 months.
Oh, yeah.
So it's probably around 25% turnover.
Okay.
And the same for our consideration set. And we do adjust stuff. We've lowered our market cap requirements. We've lowered increased some other requirements. And that's just our quant part. So we run that once annually in the fall, and that gets us our consideration set. And from there, we're doing our deep dive, and we're choosing the 20 best. And we organize our research into pillars. And one thing, I guess, that separates us from a bunch of how a lot of ESG is done on the sidelines. You have a portfolio manager, and this is at many ESG shops. So you have a portfolio manager who's the security selection financials expert, and you have the ESG team who's a separate team who they're not portfolio managers, and they provide research. They look at risk. They have inputs. They help the PM choose best in sector, but the research into non-financial inputs is not being done by the same person. So that's we treat workforce data and environmental data as fundamental data, as fundamental company information. And so we don't have separate people researching it. We don't treat it separately, and we don't look at it separately, and we don't weight it differently. We think change in diversity year over year in the leadership level is just as important as free cash flow growth year over year. They're both signs of innovation and agility and a company's ability to grow and change. So that's where our deep dive looks a little different, because we're purposely treating the non-financial information as equal. And so we're looking for the best fundamental performers who are also changing the world most positively, making the most net positive impact. Mm-hmm. And to be fair, in ESG, the best companies in the world still have tons of problems. There is not some miracle company anywhere in the world, no matter how small it is, no matter even private impact investments, that can't improve, right? Whether that's governance quality, racial diversity in leadership, reducing their water use, making more money. Everybody can get better. And what we're looking for is really, in all of our research, is this company purpose-driven, and is that purpose aligned with their stakeholders? Because if it is, that's how they're going to keep on making money. And that evidence for that is the financial year over year, the traditional, managing their debt capacities. It's also their ability to improve women in leadership, because frankly, there's no company in the world that doesn't need to improve women in leadership. Their ability to report on and improve racial diversity in leadership and tech roles and on the executive team. There's all these ways of looking at a company in their governance quality that are not financial. And so, folks think bringing in non-financial data is a drag on returns, which is hilarious. But when you throw out traditional theory and the idea of shareholder supremacy, the rest of the world, the end buyer to what we're selling, believes companies not destroying the world will outperform in the long run. I get that a whole bunch of people don't believe that, but the folks that we're selling to, the endowments at universities that study climate change, the pensions of mostly female employees, the foundations working on racial equity or gender equity, they're doing this for a reason, and it's not to feel good. It's to drive economic productivity, right? When we're all better off, when all stakeholders are better off, whether they're employees or customers or supply chain or even shareholders, we all make more money. We collect more taxes. It all works. So that's not conventional wisdom in investing, and I understand why not, because not that many folks studied detailed microeconomics. But the end client understands that. It's just all of our mucky investment industry language that has shifted the focus of governance from stakeholder governance, which is what it always was and intended to be, to shareholder primacy. And there's a variety of things that happens in life that cause that. But good companies, purpose-driven companies, even the ones that are making tons of money, believe in stakeholder governance. And so that's what we're really trying to identify. And it's not perfect. Like, nobody's perfectly stakeholder governed or driven. It's the intent in the evidence that we're looking for of that.
All right. Well, I want to take that a step further and learn a little bit more about some of the things that you're looking for. Look, when it comes to ESG, I think we can all agree it's a spectrum, and it's really something that, unfortunately, but actually fortunately too, you're starting to see more companies start to really pay attention. But as you just said, even with the companies that you have in the portfolio that you look at, there are still issues. So for you, what are some of those things in particular that you look for when you're considering a potential investment of the 45, and then you're trying to narrow it down?
We use, how many is it? 52 inputs in our deep dive.
That's it.
Yeah, well, it's a lot of them have multiple points in them too, but we that's the total inputs. And some are quant and some are qual. Some are multi-part, some are very simple. And we organize them into these pillars, and we assign ratings for each pillars. And so we're really just ESG. Let me back up. ESG data is a mess for two reasons. One, it's separated from the financials. That will not be true in 5 to 10 years. It will be reported in the financials. Two, a lot of it is BS. So if you, the data that we use, quant and qual, generally goes around workforce data. So that could be anything from diversity to turnover to parental leave to pay equity to various workforce data and in environmental inputs and outputs. Stuff doesn't fit into those two buckets, but that covers the main set of data. So that could be hazardous waste, recycled inputs, commuting, that kind of stuff. The problem, and where we're kind of lucky, is the data sets lag behind for two reasons.
That's where the opportunity.
The standardization is slow and fast and varies by continent. And I'll give you some examples of that. and folks don't know what to do with it. So the best example is racial diversity data. So when we started in 2018, we had looked at the ESG data sets, and this is still true to today. Board diversity is only measured at the gender level. So there are very few ESG data points in the world right now that you could buy that take into account racial diversity at any level: board, management team, leadership, employment. What's interesting is most American companies have to report this stuff. So in about a year or two, nobody's in the US anyway is going to have an excuse. There's a California employment filing that they have to do that has to break out employee racial and gender diversity by level. It's pretty cool when you come across it on some websites. And so that reporting in California is actually driving disclosure in the US. So when we started in 2018, I'd say maybe half of our companies in our consideration set were reporting racial diversity. In addition, they were all reporting gender at some level. Now they're all reporting racial and gender diversity. And so, we're not holding companies that need shareholder votes to get them to report diversity. Let's be honest, that's a whole other side of the ESG industry. We're holding companies that are leaders in this reporting, and they're not leaders in this reporting because it makes them feel good. They're leaders in this reporting because they believe this data is fundamental company data. They believe their performance on employee turnover and pay equity is fundamental to their company performance. They believe making all of their products with recycled materials is good for the bottom line and for sales and for the environment, not exclusive of each other. So there's this cat and mouse game going on with regulation, people like me who want data, companies providing data in the standardization of that data. In where it's going is the big four accountants are going to figure out how to charge it on audits and double their audit billing. And I can say this is because I've read a whole bunch of annual reports where EY and others have done the full audit of the ESG disclosure. So we're 5 or 10 years away, but right now there's a whole bunch of bodies everywhere trying to standardize the data. The data is going to come standardized out of US requirements. Canada doesn't care about diversity. EU sort of cares about gender diversity. They don't care about racial diversity. So 2 years ago, it wasn't clear the US was driving reporting and data. Now it is. But what we do is we build custom data sets. So even though we can't buy quant or qual any research on racial diversity, the data is there in the companies that we're looking at. So, and that's one of the benefits. The ESG providers have to rate 3,000 companies, right? How do you standardize it when there's only 800 reporting? Whereas we're only looking at 45 and basically they're all reporting it. So we have an advantage in that, kind of we're looking at the next generation of reporting. We're building our data sets from that. So it could be on the non-financial side, we look at executive team diversity as a total number. So gender plus racial diversity. We look at women in leadership year over year, racial diversity in leadership year over year, how that's changing, right? We want to see change, right? It's not about some absolute number for any of this stuff. It's, are they making progress? Everybody needs to make progress. Believe me, there's no companies in the world that don't need to make progress on, even if you've made progress on gender diversity. Let's say you're at 40%, woman in the workforce. Are you above 20% women in leadership? How are those roles, part-time versus full-time, divided? And it's not because we feel good. It's because change, setting goals and achieving them demonstrates a competent board. And nobody tells me I'm wrong when I say that, because it's very intuitive, but folks in the traditional investment industry have a hard time figuring out what to do with that data in security selection, right? And the data is not there, right? It's not necessarily available. It's just even below the board level, beyond gender, it's not standardized, right? So you can't just buy a data set and rank your whole, you have to do a lot of digging, but we do the digging because we know it's going to be standardized in the fundamentals. And it's not just the auditors that tell me, that they don't tell me, that I can see that they're charging for it and doing the real audit. It's the company. So now you see combined or integrated annual reports, especially out of Europe, but you're seeing it in the US now, where they take workforce information. So not employee volunteer hours or ERGs or, donated items. They take the actual workforce data and the actual environmental data, and they report it in the annual report alongside the financials, not as an appendix, not as a separate document, as part of the annual report. So it'll be very interesting. And I didn't understand that when I started, because I didn't come from ESG. But it's been the speed with which the data availability is changing. And it is absolutely half these big companies jumping on the CSR bandwagon and looking to fill out surveys and get high scores. Like, we're looking at something, an ESG rating. We look at them all. They all have problems. We're looking at one last week, and one of the categories under, I don't know, I must have been under S, was awards won for sustainability. And I was like, this is ridiculous. You should get no points whatsoever for winning an award for sustainability. But because of how these ESG data sets were built separate from the financial data sets, they've kind of taken a life of their own. And, if you don't have robust workforce reporting, which they never really had until this US reporting showed up, what do you do with it? Right? So you come up with all these other ways. And anyway, so we're in a really cool evolution of data. It's kind of like if you go back 15 years to financial data being standardized and available, we're kind of there. It's a different problem because the financial statements were already standardized. Mm-hmm. But so for us, it's more of an organization standardized. But as soon as that happens, we'll think of the data very differently as an industry.
So for those who are listening right now that may not consider ESG yet, maybe want to, but just don't even know where to start. As you said, you have your own organizational customized data sets that you use to help when you're evaluating, your own ESG scores for your investable universe. So what would you say of I know you said all of them are equally weighted, but what would you say are some examples that maybe some individual retail investors that might be listening to this right now could maybe look for and assess for themselves?
I think so. One of the big problems with ESG data is it trails off a lot as you get lower down in the market cap and ex-US and ex-Europe, which even impacts our research in larger cap international, and even in some less covered stuff. So we have companies that just didn't get on the reporting bandwagon until recently, and so their scores are lower. So I would suggest to build your own data set. So you go to the company website, figure out what their purpose is, understand if sustainability has even hit their radar. I'm pretty sure it has. Everybody's got a sustainability subsection. Look at their sustainability report. I have directed a number of smaller cap and micro cap investors. Most companies have this, or a web page or something, and it'll explain to you. It could be 6,000 pages. It could be 100 words, but it'll explain to you where they are in their journey. From a board perspective, because this stuff is about the board. And I say it's about the board when I say it's about the whole organization. So it's not about the CEO doing one thing, it's board initiatives. And you can look at the board diversity. If it's a tech company, it's going to be awful. You can look at the management team diversity, but really you're not going to get any access to ratings or third-party stuff as soon as you get kind of under the $5 billion market cap. But it's really, I think you're going to see a lot of company reporting along stuff like this. And some companies have always been doing this properly, but they haven't reported it. So you have to be very, very conscious of that, unless they are in an industry or a country where it's been mandated and pushed. It's okay if they're not reporting a bunch of this stuff, especially if they're smaller, but you can get a pretty good sense from company reporting of all sorts, even their website, of what role long-term focus and sustainable growth fit into their organization. If a company's short-term and not focused on long-term sustainable growth, who cares how many women or racially diverse folks they have on their board? Who cares how much water they've, saved? what you're really looking for to do it right, to use this data in addition to financials to find companies that are long-term outperformers, it has to be ingrained in their purpose. And their purpose, it's really simple. Their purpose, which usually is pretty clearly stated by any company in any of their stuff, ties into their stakeholders. So they're doing X for their stakeholders, as opposed to we're the best and the biggest company in the world. And so it comes down to, even when analysis we did in April, we just took the first 2 paragraphs from everybody's quarterly report, and then we compared it to like the top 10 or 15 by cap weight in the index. And all of our companies were employees, clients, and everybody else didn't mention employees and clients, right? So there's so many simple ways, but it comes from what your goal is, right? And our goal is to hold stakeholder governed, long-term focused companies. So it's easy to look at the data through that lens. And so I think that's what folks miss is why. Like you have to define the why you want to use this information or why you want to invest. And I think for the average, even the guys who are portfolio managers in this industry, even they understand long-term sustainability and long-termism and the benefit of that. And so it's stakeholders is not a popular term in investing, right? And I think as the industry evolves and changes and matures, it will be. But I like to think of it mostly from a stakeholder perspective. Are they serving their stakeholders? If they're serving their stakeholders, they'll continue to make money in a purpose-driven way with less impact. And that's another thing. These companies make huge impact. There's this idea that you can only invest in private investments. A company employing 500,000 people makes a huge impact, underpaying 1,000 of them, only providing part-time hours to 50,000 of them so they don't qualify for medical benefits. That's a cost. The company doesn't have to pay for it, but the rest of us do. So anyway, so think big picture and then worry about the data and the research. The companies, and be very skeptical of checkbox exercises. And rating systems, there's some really interesting rating systems that are okay, but again, they're mostly large cap. And so even, we can't use any of them for our strategy because we get into kind of mid cap and global stuff.
No, what I appreciate so much about your strategy is ESG is the whole aspect of ESG is very important, but it seems like the G for you is probably the most important.
Yeah. And in my new thing is F. So financials plus social, so workforce data plus environmental data. So E plus S plus F equals G. And that comes from, that is the crux of our strategy, which is well-governed companies are purpose-driven and long-term focused. Therefore, we want to invest in them. And so workforce data fits under the S, but I think it's governance data. But I also think the financial data is governance data, right? You're assessing the long-term consistent growth, in our case, of this company. So it really speaks to governance. And governance is, if you were quantifying the impact of governance in an academic sense, it would be turnover, right? Not of the board. Who cares about turnover of the board? It would be turnover of senior leaders, right? It would bring in financial, it would bring in the workforce characteristics. It would, measure against goals set and achieved. So it all overlaps. And that's why ESG, lumping everything into 3 little silos separate from the financials, is a problem, even though I'm going to use the term forever. But it's
ESFG. It's a little bit of a tongue twister. We got to get that. We got to get that into the mainstream.
Yeah, I talk about it a lot because you're right. It does all feed into governance, and governance is underrated. But a lot of really good portfolio managers have been looking at governance. They wouldn't look at, let's say, diversity data because there would have been none reported 10 years ago. But if they see turnover, if there's pay equity issues, lawsuits related to, senior folks leaving and things like that, that's all S, right? They were already looking at that. So it's not that we're just kind of co-opting the stuff that fits our financial model. It's that companies are more than their financial metrics. Like, and so only looking at the financial metrics misses the whole story. Folks get to different end goals with it, but it's really for us that the long-term responsible growers, and how do we use this data wherever it comes from to assess that.
Very good. So one of the main reasons I kind of asked that is because on the panel that I did back in August, where we had Garvin J. Bush, Phil Kirschman, Lisa Hales on, where it was kind of like an ESG 101, for geniuses like me. And, one of the questions I had for them was, it especially when you're trying to wrap your head around it at the beginning, when you're first like, okay, I want to invest in a way where I feel like I'm doing good for the world. I'm investing in companies that are, really creating a bright future for all of us, whatever that the case may be for that individual. Right. And, we were talking about in the context of, sometimes with various sectors out there where, not necessarily, taking away like, cigarettes and gun manufacturing and all that stuff like that. Let's push that aside for now, but let's talk about, just mining or minerals extraction companies in order to fund some of these electric vehicle companies in order for a sustainable future. It seems like you could just go in circles and circles when if that is your primary focus and not really paying attention to the SF and G aspect, you could just get completely lost. So for you, how do you weigh that E aspect when you're looking at the various sectors for your investable universe?
Well, we added a net zero commitment as one of our deep dive inputs this year. And we knew it was going to be interesting because it means a lot of different things to a lot of different companies and people. But there's this idea that you can reduce your emissions a bit and then you can pay somebody to offset them, which I guess works. But if we're measuring, if a company has to pay for their solid waste disposal, if they have to pay in certain regions in the world for their carbon credits, if they have to pay higher healthcare taxes because they're making everybody sick, it should be in their interest to truly reduce their environmental outputs. So the E is really messy, and we come at it from an evidence-based approach. Everything has fossil fuel in it. There is not a company in the world that doesn't have fossil fuel, whether it's plastic, commuting, transport, buildings, plane travel, shipping, actual plastic making, actual extraction. So this idea, and we're a fossil fuel free strategy, by the way, but I say no company in the world is without fossil fuel, is fossil fuel free. So that's how messy it is. And some of the stuff is systematizable and some of it's not. What's been most interesting, I think, since we started is everybody's been working on reducing their water use. Everybody's been working on reducing their emissions, or, their emission ton per, $1 million in revenue is kind of the standard measure of that. But that's just emissions and water. Like, what about products inputs? What about shipping container size? One thing that I think does not get enough appreciation, it certainly does not show up in any ESG rankings, is if I have a product and it fits on a slat, right? Ships and boats across the world. And I can go from 100 units to 130 units on that shipping. Not only do I make more money, I can ship way more, right? For the same emissions, it doesn't count towards your company as much, the shipping emissions. But so there's all these things we can do, and I'll come to the electric vehicle question in a second, in a company. But since we focus on just the big things that everybody does, the important stuff like recycled inputs, right? There are a lot of clothing manufacturers who've gone, oh crap, in the last couple of years. Not only is this stuff expensive, like virgin materials, our supply chains are a disaster. We can't figure out where any of this is. People are making us audit these supply chains. So there's a whole bunch of incentives to get them to shift to 100% recycled inputs. So 100% of their products, clothing products, will be made of reused material. That's a huge shift, right? We see the same thing in food containers, right? So food containers, recycled inputs wouldn't make any ratings, but if a large paper manufacturer can start making styrofoam out of 100% recycled inputs as opposed to new material, that's a huge impact on the environment. So that's how messy it is. And it's just super messy. And your question is right. It's just messy. With EVs, one of the things that bothers me the most in our industry, the sustainable investment industry, is the most efficient is cycling, walking, and public transportation. So why aren't we advocating for any of that, right? And I'm not saying single driver electric vehicles are bad. I'm just saying if this is about a livable, environmental, breathable future planet, if we do care about people and stakeholders, there's a place for individual cars, no matter how badly the extraction destroys the environment to get the battery metals out. But we kind of blindly support those EVs as future hope. And we don't even think about hydrogen and things like that as much, when in fact, it's a much bigger question of commuting, employees working from home, urban planning systems. In my history degree, and I'll just throw the US under the bus because it was a US history, but this happened globally. You have corporate interests sidelining public initiatives for all of history, right? Whether you go to the electric car, whether it's street cars everywhere that were electrified that got pulled out by the oil companies and the car companies who wanted to sell more cars and not compete with the electrified trams everywhere in the US. So we've done this all this time. And I'm not saying, Tesla's in there or whatever to steal from subways, but sometimes in our investment industry, we live in a bubble, right? Where everybody has their own car. Everybody isn't, we forget that there's regular people, right? We forget that not everybody owns stocks, right? I think it's like 60% of the US, similar in Canada, don't have any investments, let alone individual stocks.
It might be less, actually.
Yeah, it might be less. We all think everybody has retirement accounts when in fact a lot of people live off of their pension, like Social Security and CPP up here. And so if we're really here, if these companies that we're investing in, and if our industry is really here to be more sustainable, it needs to stop being about product solutions, and it needs to go bigger, right? How is the whole system changing? And we saw a lot of sustainable strategies not being able to capture that. They were getting companies get credit for, the tick box, the activities they do that fit into the boxes, they, end up in these ratings. And there's so much change that companies can make, even just hiring veterans, right? Having diverse supplier programs, realizing you're spending $10 million a year, but it's all with white male-owned businesses. Well, we can, as part of our procurement process, we can ensure that more revenue flows to businesses owned by women, businesses owned by minorities. And so there's all these things we can do. And to think of it, and that's one of the problems with ESG, is it limits it to that set of criterion data sets, whereas it's really about systems change. It's really about the long-term sustainable growth of the world. And there's a place for everything, but we have to critically evaluate it and be very conscious that there's often a marketing hook and a conflict of interest driving the popularity or the uptake of something.
Yep, I couldn't agree more. It's definitely more of a systems change that I think is what we really need to see. But we're now at that point in the interview that I have. This is my favorite question to ask everybody that I have on here. So it's what would you say is an invest? Oh, by the way, you did mention Tesla. Are you currently a shareholder in Tesla? Okay, good. All right. For those listening to the audio version, she is shaking her head. No. Okay, there we go. All right. And so now my favorite question. What would you say is an investing experience that impacted you the most thus far in your career?
Like related to security selection or
anything related to security selection, experience at any of the firms you worked at. Anything. Meeting your partner,
Yeah, that too.
I mean, that's a given right there.
Yeah. Yeah, that was kind of a big trigger. I think it was launching ETFs. And I say that not because of the ETFs, not when we don't have Honeytree ETFs yet. One day, it was not that we did ETFs or learning about ETFs. It was kind of it was where everything came together in kind of my learning, products, portfolio construction, and ESG all kind of intersected, and we had just kind of built out or begun to build out a large SMA platform. Like we were on one of the big wirehouses in the US and had built that out. And it was kind of just perfect timing of the market opportunity, right? For concentrated active strategies and or ESG strategies and an understanding of vehicles. And I'm a big picture thinker. And sometimes that means I'm a slow learner. And sometimes I need a bunch of things to kind of come together. And so the fact that I met my partner before that and everything kind of the opportunity, the problems in the industry all kind of clicked together. And I think you're driven by purpose best when you're trying to solve a problem. And so that really kind of was the changing point. We realized there was a problem, and it came not just from ESG being a bunch of greenwashing fake products, but from we can be a solution. This is how the industry is changing. Everybody says active is dead. Arguably all small firms are dead. But there'll always be, the idea that everybody's only going to eat at Chipotle and not I don't own Chipotle, that everybody's going to eat at Chipotle and not at a local Mexican restaurant is hilarious. There'll always be a huge demand for local boutique, more specific products. And so that's kind of our, it is a marketing learning. I mean, I think most things are marketing in the world too. I think in the investment industry, we don't talk about marketing enough, or advertising, but it was that filling, that all the learning that I'd had to that point, hitting us with, here's how we can solve a problem. Here's our purpose. And so it was both the portfolio construction and the marketing in the industry as a whole and the ESG all coming. And that's where Honeytree came from. Otherwise we probably wouldn't be here if we hadn't had that set of experiences at that time.
Very cool. Well, we're there at that point in the interview. I want to keep going, but I think, we could fill up another couple hours with everything that I want to ask. But with that, where can my audience go and find more information about you, Honeytree, follow you, as well as follow you on social media? Yeah.
So I rant most about ESG on Twitter. I try and do it on LinkedIn. Nobody cares very much. There's a whole bunch of other reasons there. So Twitter, my handle's at Liz Simmie, LizSimmie. You can check out our website. We will be SEC registered in the new year. So we are not holding out to Americans right now. But you can check out our website at honeytreeinvest.com. And there's some contact info there. And if you want to sign up we have a monthly letter that is not 86 pages of investment performance. It's a little lighter hearted that you can sign up for there. And I'm pretty good at, as long as you're not selling me something on LinkedIn, and accepting connections. So feel free to find me there.
Very cool. Well, Liz, thank you so much for joining me today. This was an absolute pleasure. I learned a lot today. I learned a lot about your thesis and the way that you look at potential new investments. And I hope everyone listening did too. So with that, thank you so much for joining me today. And I look forward to our next chat.
Thank you. It was great.
Thank you. This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast.